I wanted to make a quick video that may help investors or agents working with investors on a decision of whether they should sell a property or lease, rehab, re-tenant property at a higher price and then sell in the future for a profit. I'm currently working on a property and I'm doing leasing for the project. We got an unsolicited offer on the property and I believe it's a great offer. And I wanted to convey to the owner that it may be a better decision to sell it at this price. The potential buyer is an operator and an owner user, and typically owner users can pay and will pay a higher price per square foot than an investor would, based solely on rental income. So we're gonna do a quick little breakdown, kind of showing the potential income in the future of the property versus selling it now, and comparing what the price differences would be and what would be beneficial and better for the property owner. Sometimes, the figures and the numbers aren't the only reasons property owners hang on to properties or sell properties, but it definitely clears a lot of things up for me, and I hope it helps my clients, and I hope it helps yours. So stick around, let's dive right in.
So we have price per square foot, it's $263 per square foot. The size of the building is 6,500 square feet. So the purchase price came in at $1,709. And it actually was a little bit higher than that. Maybe they included 6,650. My apologies. So yeah, came in at about 1.75 million. So the owner's thinking that if they lease this up, lease the 6,650 square feet fully and at a higher price with better tenants, they would be able to achieve a higher price higher than this. I disagree completely, and I'm going to show them why. And it's a very simple calculation that we can do. This is just a back of the napkin illustration, but if they requested a further in-depth look, that's the next conversation piece. But just to kind of show them, this would be interesting. So say lease, and right now we're marketing the property for $1.67 a square foot, and that's modified gross. The tenant pays for their own electricity, utilities, and everything except property taxes. So here we go. The owner owns a property, and we'll find out how much they paid for it. Just log into Title Pro. Here we go. So we saw that in 2013, they bought it for 1.120. They pay $15,190 in taxes. Okay, so much they pay for every year, on average. So it might fluctuate a little bit, but that's what they paid for 2019. So we can get into just kind of plug some figures that we're going to use later. So property taxes. So annual property taxes. Okay, so let's say they can achieve 167 per square foot for all of the 6,650. Right now, they're way below market. They're probably close to $1 a square foot for all their rent. So that's why they brought me in, to try to improve their property. And even at the 167 figure that we're asking, and it'd be $2 a square foot full service. Let's break it down. Here. So let's see, $1.67 times, we'll move this over here. So we can call this asking or rental rate. And then we're going to have square footage, or the rentable space. It's 2,650, which we have up here. Total monthly potential rent, and it's bigger. So if we leased every space out at 167, we would be left with 11,105 every month. So then this is total annual figure. So just take this and multiply it by 12. Okay, so it's $133,000 per square foot. So we can kind of look at CoStar and see what the cap rates are in the area. If you're an expert in your area, you probably have an idea of what the cap rates are. So we can go to sales comps, and I'm just gonna do a general Santa Ana area. This property's in Santa Ana. Okay, and we're gonna do properties that sold within the last year. Okay, done. See what it comes up with, and we have a list here. It's 114 properties. Gonna go to actual cap rates, and usually the more distressed, the more difficult the property, the higher the cap rate is going to be, because it's going to be a riskier asset to maintain, and typically the lower the cap rate, of course, it's properties that are a little more stable and better tenants, if you will. Oh, here we go. So I clicked it and all the empty ones went to the bottom, and now I clicked it again, so hopefully it goes up to the top. It's pretty good cap rates. Let's look at some of these properties. Let's take multifamily out of it. This is a retail asset, so we're going to select all, and actually no, let's do office retail. Should be it. You don't want to look at multifamily because it's going to be a different cap rate. So really the only one that had a cap rate in that whole market, and sometimes I don't report it, but let's see. Actual cap rate. That one I sold, and that one sold, but it's not revealing cap rates. So that's kind of the trouble with the data that you're given. Sometimes you're left to get your own cap rates, but maybe if we widen our parameters, I know every city is going to be a little bit different, but if we widen this, can I get it more? Still localized, it's not as broad. Okay, 145 properties, and they're all office and retail. Okay, let's go back to this, see what happens. You just gotta mess with it. Okay, so we have more data here, which is kind of, this is closer to what I was kind of looking for. So office buildings, nice buildings here. Circle K, you know, for 5% cap rate. So we definitely don't have tenants like that. We do have good tenants, but we don't have tenants like that. So my guess is that it's closer to a 6.5 to 7% cap rate, which is what it would actually trade at comfortably. We're going to use that as our figure or data. So market cap rate. Okay, cool. So we have, for the most part, our data here. So then we need expenses. So lease, this is another figure, insert purchase price. So they bought it for 1120. And we have their property taxes. So purchase price and assessed value. We may not use, but just in case we need it. 1, 2, 3, 6. Okay. Purchase value, assessed value, offers in at this. So it's a pretty good difference. Let's see if once it's leased up, it can achieve more. Again, rental rate, potential income. We need expenses too. Income, here we go, equals this, annual, right? Expenses are gonna be property taxes, which we have, and then maintenance. We'll keep it kind of simple. I don't know, let's do $5,000 a year for landscaping and just cleaning. We should set aside reserves for like painting or even the new roof that we installed, paving of the driveway. So that's probably why the assessed value is a little bit higher. Probably just spent $136,000 in improvements over the years. Basic expenses, and since the tenants are paying their own utilities, again, this is like the rate we're hoping for. It's probably going to be closer to $1.50, $1.25, but just to give, the idea that it's possible, potential. And let's do repairs. Another $5,000 cash money. Total expenses realistically, it's going to be higher than this. Okay. She also told me she has a cell tower on top of the building. Let's bring it in $2,000. So additional. She has a cellular tower, like fiber. So let's bring in an additional $2,000. So that's good. We're gonna factor in total income. Equals. Cool. So we have income, expenses, total income, total expenses, and then we have net operating income. Net operating income. Okay, equals this minus this. And this seems really low. Still $110,000. Cool. So you get that, you achieve that. Now, a simple back of the napkin calculation that we do to get a quick value is we take the market cap rate or whatever we want to achieve, which I think 6.5% here is feasible. The tenants again are not first grade, second grade, A class, B class tenants are more C, D, some F, not paying their rent. Uses that can't be supported in the area, unfortunately. So it may serve a small portion of the community, but it's not enough to pay the rent. So net operating income. So if we take the net operating income, so let's say cap price with market cap rate. So if we take this, the income divided by market cap rate, we get a price. And this is 1,693,475, which that is the price that would be achieved. Now, again, we're going to have to factor in a new property tax that a new owner is going to have to pay. So it won't be $15,000. It won't be the $15,000 property tax. So when you do pro forma of what it would be worth to somebody now, if we're just taking in the NOI. So in the calculation, we're going to do two different, and this is just what it would be worth to the owner. So now we got to do a similar one with a different property taxes. So here I'm going to do new property taxes for new buyer. And it's going to be a percentage of the new price. So we might have to do an interesting calculation. So let's say we do price it at, the offer we got, or even 1.7. So equals, and typically property taxes in our area, let's do another, so property taxes equals 0.012. It's usually 0.125, 0.112%. I'll do 1.22% just to be a little safe and make this a percentage. Okay, of the value of the property. So property taxes equals this times, and we have to come up with the price here because we can't use that. So let's say we go out at 1.7 times. So the property tax is at 1.7, and let's put this actually over here. Let's see, for future asking price. It's gonna get confusing. Say we list it for 1.7. We can always change this. That's why I'm gonna do it this way. So we got this times the future asking price, right? Again, it's not a percentage, it's a dollar amount. So we have 20,000. So this isn't going to change too much, even if, like, let's say we want to ask 1.6. I mean, it's going to go down a couple $100. I mean, it might make a big, a little difference, but it's not going to be huge. So even 1.8 million, another couple $1,000. So I think 1.7 is a good figure to be at, especially if this number came in pretty close. So now our net operating income with this new figure. Let's see if we can copy that. Copy that. So equals tab, enter. So now we have total expenses of 3,000. So the end operating income for a new buyer. Let's make a little space here, just so we have a difference. So the operating income would be, and this, put it here, minus this. And I'm only doing that so that here I can just put the total income here. So then our NOI went down by about $6,000. So now we get our cap rate here. We get this divided by market cap rate. Comes to 1.607. So let's see what happens if we lower this. Since now we got 1.6. Let's see what happens if we lower this to 1.6 asking price. Yeah, so we're getting close to having the same figure here. So we can even kind of keep getting closer if you want to get pretty exact. So say 165. 61, 62 right there, 162, 162.3, pretty close. So let's say, yeah, it's the same. Property taxes are going to be pretty similar to what the asking price and what it would be worth at that point for a new buyer. So this is what it would be worth to a new buyer once it'd be fully leased. Once it's fully leased. I mean, we can see if we can achieve better tenants and see what it would be worth at even a 6% cap rate. Everything's going to change now. It's worth 1.758, but we would have to adjust our property taxes again. So future asking price is 1.75. Let's do 1.7 here. 742. So we go 7.1. 7. 2 here. 38. 733 here. 4. 35. Okay, pretty close. 735, 1.734. So again, at a 6% cap rate, it's worth 1.734. Then we get into the 5.5 cap rates, 5% cap rates. I highly doubt someone would pay above a 6. So even at this figure, even at a 6% cap rate, it's worth 1.735. Even at 1.75, 1.734, 1.735, we got an offer at 1.748, which is higher than what it would be projected in the future if it was fully leased out, if the economy was good, if timing was perfect. I don't think that it would be worth to try to lease it, take on the risk, because again, the market could go down. The market could be bad. To the owner, it's worth 1.83 at that point in the future here because they have a lower tax bracket. But again, they did also put in some money for improvements. I don't know if it's actually the difference of this minus this. Okay, so $116,000. So even subtracting this $116,000 in improvements, because she did place a roof. There's an AC unit that costs 10 to 15 grand. The concrete, flooring, and painted. So maybe not too far off from what she's invested, not including holding cost when the market hasn't been super great. So if that's what she's in it for, that's what it's worth for. Once it'd be fully leased up, versus what it would be worth for an investor at a cap rate with their new property tax, and then. That's what the offer that we got in. Versus future sales price. And again, this is guaranteed. This is a guaranteed price. This is in the form of an offer. This is already given to us. This is in our hands. This is, if we time the market right, if everything goes on correctly and we're able to achieve this price, and if someone's willing to give us a 6% cap rate, could be significantly less. The market here is not paying 6% cap rates for assets that are a little uncertain. In my opinion, that's not what's happening. So you would get $13,000 less. This is the difference here. You'd be getting less in the future. And the reason this is because typically owner operators will pay more to occupy their own property. It's beneficial for them, which is something that I'm going to make in the next video of why an operator is better off buying versus leasing in some cases. So yeah, it really depends on a case per case scenario, because I'll get into that in the next video. Anyways, guys, I hope this helps somebody, anybody. I hope this helps any broker or decision maker, or, investor trying to make a decision about their property. It's a simple breakdown. I'd be happy to share this too. Let me know if you want a copy of this. I know it's not super pretty, but you can plug in your own figures and come up with the same kind of numbers here. So I know it's not outlined. You're welcome to organize it how you like, make it look pretty. But this is a back of the napkin kind of description of why it's beneficial for the property owner to sell now and to keep the property. So again, hope this helped anybody. Have a great day.